Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use creditor tools, specifically pro forma cash flow statements and loan modifications. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Debtor-Proposed Pro Forma Cash Flow Statements. It is the bridge for repayment. This is all about the cash flow position at any given month or time. Commercial loans are typically structured to include regular financial reporting of business financial statements and tax returns, as well as personal financial statements and tax returns for guarantors. Such data are regularly analyzed, and if the creditor is doing his job correctly, like asset quality monitoring, it should be apparent to all stakeholders when evidence begins to emerge of financial deterioration. At the end of the day, a well-prepared business cash flow pro forma statement is one of the strongest tools to use when negotiating a workout situation, a loan modification, an extension, or payment deferral. Sure, the creditors will always expect to have on file all required, appropriately prepared financial statements and tax returns for the most recent year-end and interim financial statements through the most recent quarter, together with any other required reporting. But special attention must be paid to your actual and pro forma or projected cash flows in a potential workout situation. A pro forma cash flow statement is the ability of your company to meet its estimated operational, investment, and financing activities. If you're in deteriorating financial condition, then you will have to make material adjustments to these activities and show the creditor the availability of cash and when he will receive his loan repayments. Next, let's talk about the frequency and quality of financial reporting. Depending on the severity of your financial condition, you may need to prepare the pro forma financial statements, including one for your cash flow, to include amounts by month for the next 12 months, quarterly, semi-annually, or annually. If there's a risk of imminent failure, financial reporting on accounts receivable may be prepared daily as well. Cash flow statements will show the stakeholders your estimated cash position. This is no time to blow smoke by showing estimated amounts you think the creditor needs to see. Don't ever go there. When you know that it's not accurate, don't do it. Rather, be sure to show the cash position you honestly believe and expect to be there. Make sure you estimate the numbers you are very confident you can produce, regardless of how bad or good that may be. If it's bad, then so be it. That's why it's called a workout, meaning that there will need to be modifications to your loan documents that reflect your ability to repay. The creditor is already used to seeing deteriorating financial statements, so he won't be surprised at all. Once the parties have settled on the type of financial reporting is going to be provided, the cash flow statements in particular, they can be regularly refreshed as things change. Additional modifications can be made as well. Make sure you clearly understand that the pro forma cash flow statement reflects what you are truly comfortable with. Think about it. If you prepare and present your best case pro forma or projection, the lenders are going to expect that performance and will hold you to account for any material variances. They may also not be all that forgiving if you come materially short. In other words, don't fudge and put numbers in there you think the lender expects to see that are too high. Put some work into the pro forma projections and own those numbers. When they change the pro forma again and send it in so the creditor is aware if you're off or not. No surprises. Don't mess around with the numbers, especially when there's an economic downturn, in other words. Their job is to ensure your loans are returned to an acceptable pass risk grade as soon as possible or to a zero balance. They don't want the relationship on the books. The more problem or classified loans the creditor has, the greater the pressure there will be on the creditor and you. You get the picture, hopefully. There's going to be a ton of pressure on their end, and thus on you, so you can expect it. Doing this wrong by overestimating your cash position will likely result in a stressed relationship, if not worse. So figure out what you really expect to happen and tell it like it is, good or bad. After all, in the end, it is what it is and will be what it will be. In short, refreshed financial reporting is warranted anytime there are material changes to your operations, favorable or otherwise. The level of frequency for financial reporting, be it daily, weekly, monthly, quarterly, semi-annually, or annually, will likely depend on the level or severity of credit risk and the size of the deals. The frequency will either increase or decrease as conditions merit, so always be ready. Next, drilling down into the pro forma cash flow statement. Okay? The pro forma cash flow statement will focus on future cash receipts, all the inflows, and cash disbursements or payments, all the outflows, from activities in all of your operations, any investments, and also any financing that takes place. The net cash position from these activities at the end of the period will be added to the cash at the beginning of the period for the final period cash position. You will have documented not what the creditor expects, but your best estimated or most accurately estimated cash position for the respective periods. Make sure it is reasonable and that barring any unforeseen emergency, you will hit those numbers. Be detailed as appropriate. Let's take a second and look at these activities. Okay, the first one would be the operating activities. It includes all direct cash receipts from customers and the collection of accounts receivable. Disbursements will include inventory purchases, general operating and administrative expenses, wage expenses, interest expense, and income taxes. Add the receipts, less the disbursements, to show the net cash flow available from operations. So I just want you to be familiar with what these operating activities are. This is one of the major parts of a cash flow pro forma, is all those operating expenses and so forth. Next, let's take a little look at the next big chunk of what a pro forma is in a pro forma cash flow, all the investing activities. This includes cash receipts from the sale of property and equipment, the collection of principal on notes receivable, or the sale of any investment securities. And of course, disbursements will include cash paid for the purchase of property and equipment, loans made to others, and the purchasing of securities. The difference in receipts and disbursements will be your net cash flow from the investments. Again, just become familiar with what goes into a cash flow statement, the operating activities, the investing activities. And it's also made up of a third major component, the financing activities. And this includes cash receipts from any stock issuances or new borrowings, and cash disbursements from any stock repurchases, dividends or loan repayments. And again, the difference in receipts and disbursements will be your net cash flow from financing activities. Now, what about a more simple monthly cash flow statement? For your smaller, less complex small businesses, it's reasonable to prepare, say, a simple monthly cash flow statement for each of the next 12 months, plus, of course, the 12-month total, and simply list all the cash receipts or all the inflows, this is cash, and the cash disbursements, the outflows, together. Cash in, cash out, month over month over month. The cash flow will include all cash sales, collections from accounts or notes receivable, sales proceeds from property and equipment, sale of investment securities, issuance of stock, proceeds from new borrowings, and cash from other sources, any and all cash received, in other words. And of course, the same holds true for cash disbursements, or the outflows. This includes any property and equipment purchases, investment securities purchases, inventory purchases, general operating and administrative expenses, wage expenses, interest expense, principal payments, and even income taxes. Any and all cash spent. Again, a debtor-prepared pro forma cash flow statement is the central bridge between the debtor and the creditor. It's all about the cash. The pro forma cash flow statement will show the projected receipt of cash monthly inclusive of all cash disbursements to vendors and operating costs and debt repayments. The amount of debt that you can realistically repay at a given time over the pro forma period. In other words, you can put the amount that you're going to pay in your debt repayments in there. So hopefully it balances out. In other words, you're in charge of making that recommendation. So it becomes a bridge together with all the supporting financial documentation should enable you as the debtor to readily cross over what can feel like a Grand Canyon between themselves and their creditors. During times of economic stress, effective repayment solutions are important to the financial well-being of all the stakeholders, not just you, but the lenders too. The repayment of your loan is in the best interest of the creditor, like I said, and lenders need to avoid credit losses or charge-offs, and businesses want to stay in business. Now, this short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune in to the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Now, lenders are to prudently work with debtors. Okay, recent regulatory and supervisory guidance to creditors. Creditors expect your full cooperation and assistance per the terms and conditions of the promissory note and loan agreement. Why wouldn't they? And you agreed to it too as well, right? They will likely or should want a win-win relationship based on prudent repayment terms. They may very well be a major disconnect from how you view your financial performance versus what the lender thinks, especially if the numbers are bad. Debtors still must find a way to repay their obligations in full, eventually, but getting mutually acceptable repayment terms can be difficult. It's to be mutually acceptable, right? And you have a major voice in this process. Regulatory and supervisory agencies across the United States recently issued an interagency statement on April 7, 2020, regarding loan modifications during COVID-19. Here, I need to show you some history here, see how this works. Now, for example, banks are allowed to do disclosable loan modifications to work with their problem loan borrowers in a prudent manner, with safety and soundness as their guardrails. But let's go back and look at the 2020 interagency statement around COVID. This sets the tone and helps you understand the spirit of creditors and debtors working together, okay? It says, quote, "The agencies encourage financial institutions to work prudently with borrowers who are or may be unable to meet their contractual payments obligations because of the effects of COVID-19. The agencies view loan modification programs as positive actions that can mitigate adverse effects on borrowers due to COVID-19. The agencies will not criticize institutions for working with borrowers in a safe and sound manner." Hopefully this makes sense. This is what we're talking about. Again, it continues, quote, "The agencies will not criticize financial institutions that mitigate credit risk through prudent actions consistent with safe and sound practices. The agencies consider such proactive measures to be in the best interest of institutions, their borrowers, and the economy. This approach is consistent with the agency's long-standing practice of encouraging financial institutions to assist borrowers in times of natural disaster and other extreme events, although the agencies recognize that the effects of this event are particularly extreme and broad-based." Continuing, "The agencies will also not criticize institutions that work with borrowers as part of a risk mitigation strategy intended to improve an existing non-pass loan. Financial institutions have broad discretion to implement prudent modification programs consistent with the framework included in this statement." That was back in April of 2020. Okay? So you can see they're really willing to work with people. Okay? And they want the financial institutions to do the same. And they've got to be prudent and safe and sound. Well, when you document how you're going to repay through a nice pro forma cash flow statement, that is prudent lending. It is within safe and sound. If they just do something willy-nilly without that documented support, that's unsafe and that's unsound. It's not prudent. So if you have deteriorated financial condition and you propose repayment terms that they may not like, but it's what you think that is needed to survive and you've documented it, that's being prudent. Okay? Now, the next regulatory guidance that came out was about 2.5 years later, and this is the most recent, as of late 2024, that they're going to use going forward, that should really, really, really be understood. And you can look this up in more detail later, but I'm going to introduce it right now. They're called Disclosable Loan Modifications. I call them DLMs. And regulatory guidance changed like I said, later in December of 2022 in the way regulated creditors reported and disclosed impaired loans or problem loans. The DLM is for borrowers experiencing financial difficulty. These modifications include 4 ways. Think about this. Number 1, principal forgiveness. Yeah. Number 2, interest rate reduction. Right? That's another tool, right? 3, other than insignificant payment delays. Okay? They can delay payments. And number 4, term extensions. Okay? They extend the maturity date out. Or a combination thereof. It can be more than just one. So there's a lot of space with these tools to get what you need. Do you see what I'm saying? DLMs show the 4 ways a creditor can participate with a debtor in developing repayment strategies. Loan forgiveness may include a charge down of the amount owed to a lower balance, which helps with the ability to repay on the remaining balance. The difference can be repaid after the first position is repaid, or the first portion is repaid. The interest rate in a workout situation could be reduced. Furthermore, payments can be temporarily deferred or the repayment term extended. Thank you for joining us today. We covered the creditor tool pro forma cash flow statements as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, recommendations with us at ncara.org, ncara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own repayment solutions. Thanks again.